Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Our show today is brought to you by CommercialAgentSuccess.com. Check it out. It is training for commercial brokers, and the brokers who see it just rave about it, even the most successful seasoned brokers. Learn more at CommercialAgentSuccess.com. Well, in commercial real estate investment in general, you're always wanting to know what might happen next. What's happened in the last quarter? What's the trends on changes for cap rates and markets? And in this show, we like to look at the different sectors too. What's happening? What's hot? What should we expect moving forward? Well, please welcome my guest. It's Jim Costello, and he is with MSCI, and he's an economist, and he's been doing it for 31 years. And Jim's here in Studio One. Jim, good to see you.
Great seeing you too.
Well, thank you. And let's talk a little bit about transaction volume. First of all, here we are, February of 2025. Of course, transaction volume had dropped considerably over the last 2 or 3 years, really, it seemed. What did you see as you closed up 24, and what do you expect moving forward on transaction volume generally in commercial real estate?
Yeah, deal volume grew in 2024. We did more investment property sales. This is just looking at what's transacting. As a market, we saw growth in 2024 relative to 2023 across the board. Just for the total commercial property sales, up 9% from the pace set in 2023. That's a good thing. It just means that people are more comfortable with the market. It's more liquid than before. Some of the declines that were happening seem to have stopped. But that's the headline number. There's a few things underneath. They're still a little bit dicey. It's not like everything's fine, we're done, we've won, everything's survived. There's still some challenges out there. But it's also at a level now where we're still well below where we were in 2021 and 2022. But if someone's setting their expectations thinking, okay, where are we relative to that? Are we going to get back to the previous peak anytime soon? I think they'll keep waiting for a while because that was driven by an outside event of just having interest rates super low. The 10-year treasury was like 60 basis points or lower for a short period of time. Real estate looked really attractive in that kind of environment because it has some kind of yield when investors are hungry for yield. It's more stable now. It's not that just surge of capital coming in. It's a little more stable. People actually thinking about, well, what is the income potential for the asset class? And with that income potential perspective, we've seen certain sectors grow. It's not just like one big deal drove it. It's not just like some big entity level transaction that drove the growth in activity. Even though there was that AIR communities deal that went through last year, like $10 billion deal, right? Just as the ULI conference got going in New York, that whole week, everybody was talking about that deal. Everyone was really optimistic about the economy beginning of the week and that many more deals like that would come through. And then by the end of the week, after an interest rate shock and word that the Fed might be slowing their rate cuts, then the sentiment was really terrible by the end of the week at ULI. So one deal can turn within a week. But it seems like things stabilized since because the fears around inflation may become more muted since then. And people kind of reached a point where they said, this is about what we're going to be. It's not like we can wait any longer and get a better deal moving forward. We're not going to go back to the super low interest rates. So if we have an asset and it hasn't performed, we may as well start making a decision now because we'll be forced to make a decision later. And when you're forced to, you're not going to get as good terms as if you could do it on your own terms.
Yeah. Or it's been performing well, right? And
then you got to reap some of your gains.
Right. My old pappy said, if I'm making a profit, I'm making a profit. It might have been the profit I was shooting for, right? One of my brokers has a good saying when a client says, well, I pro forma $28 a triple net rents on this. And now the rents are to fill it up might be 24. He'll say, look, put some dirt in the hole. You don't want to fall in that hole, do you? Put some dirt in the hole. So you mentioned some properties not performing well. When you look at 2025 ahead of us, what do you see for distressed real estate transactions?
The things where I think people make mistakes are how they set their expectations by being too backward looking at times. It's part of human nature. This is how traditionally walking across the plains of Africa, Cro-Magnon man, and you see some fruit on a tree and you eat it and you get sick. So you set your expectations. The next time you see that, you say, oh, I shouldn't eat that because I got sick the last time. That's just how we survive. That's how we grow. So we always have this tendency to look at the last event and make decisions off of that. I've survived in my career through 5 down cycles in the commercial real estate market. Every time. It's almost like an evergreen article I write. This one will not play out like the last one. Yeah. And the challenge is that every time you get into a downturn, someone comes out with a fund, someone starts talking about how they're going to do deals and make a bunch of money doing exactly the same thing that Sam Zell did, or do exactly the same thing that Jonathan Gray did. But there's only one Sam Zell. There's only one Jonathan Gray. You got to be your own person and come up with your own strategies to take advantage of the current downturn in a profitable way. And this is the problem, because I think a lot of folks looked at this downturn and think, oh, distressed property sales are going to grow because prices are falling. And so we can scoop up everything on the cheap, just like after the financial crisis, and just make money as we see the capital market stabilized and asset values recover. But it's a different kind of distress in the current market. The distress then was just assets that were otherwise cash flowing, but just had a problem in the capital stack. Someone gave them a 95% LTV loan IO, and you get any kind of decline in prices, and you're going to have a bad day with that investment. And so a bunch of it came to the market at once. This time through, it's largely not the financial distress, it's the fundamental distress. It's a dead mall in Ohio where you've got brown tile and orange carpeting from the 70s, and nobody's done any CapEx, and all the consumers who used to shop there, the manufacturing jobs are gone. So it's just not supported by the same kind of economic need. It's an office building in Manhattan built in the 60s, and it's got poor clearance heights. It's got a terrible heating system. It needs a bunch of CapEx. And then throw on top of that local regulations that will make you spend even more on CapEx just to make sure that your carbon costs are in line. You throw all that together with a reduced demand environment, and something like that just doesn't look as attractive as in the past. And so it's that fundamental distress that's coming through much more this time. And so if you look at who has been buying, there's not as much distress as hit the market yet. But if you look at who has been buying the distressed assets that have come in, it's not institutional money like after the financial crisis. By and large, it's local developer, owner, operators, because the people understand that these are assets that need some TLC if they're going to be brought back into the performing market. And so it's people who can swing a hammer who go after these assets. It's someone who knows that if I'm going to get a deal and get something worked through with the local zoning board, I got Joe on the development board. He's a stickler for this issue, so I got to make sure I deal with this. It's someone parachuting in from an institutional investor from some other city. They're going to have a harder time dealing with those kind of issues. It's someone who has their feet on the ground working with all those local planning and zoning boards that understands the stickiness of all that and has all the right relationships in place to make something out of this distressed asset. So it's a different type of market, and there's different ways to make money out of it.
Yeah. Well, let's talk about some of the different sectors briefly. And if you're going to start, since you mentioned distress, let's talk about office, because that is the only sector we're really seeing where the prices are very depressed, and not all of them, but some of them are. What do you see for the office sector overall?
Yeah, there are huge bifurcations in the office market. One key one is sort of the 6 major coastal markets versus just the rest of the country. There's a big divergence there. Before the pandemic, places like New York, San Francisco, they were surging on prices. Like from 2015 to 2019, incredible growth. Some of it was fueled by Chinese money that was coming into the United States for the first time. And you had Chinese investors buying not to kind of hit a targeted IRR like a lot of institutional investors. For them, it was a capital decision. They just needed to diversify. Suddenly, before, all their money was tied up in China and real estate in China. The regulations allowed them to put money overseas, so they just diversified. They had to. The rest of the global market's available. Let's diversify. So that they spent on things in a different way and paid top dollar for some assets. They left the market because a couple of them got ahead of their skis, and so the government cracked down on too much speculative investment. And then things started to reprice in those markets already before the pandemic hit because you didn't have those buyers at the top of the market kind of pricing everybody else out. And then you had concerns that started to grow about moving into a higher interest rate environment as quantitative easing came to an end. And running an office building, it's not cheap. There's a lot of borrowing to get money to do all the fitting, all the fit out for new tenants as they come in. So that NOI relative to the CapEx spend you got to do on a regular basis, it's sometimes not the most attractive. So it was already facing some troubles. And then the COVID crisis hits. And then you've got these winner and loser buildings. Of some of them, they've got modern amenities, good features, tenants like it. But then you have some old dead buildings that are really going to struggle. And so just looking at some of the brokers, like New York in particular, and I like to focus on New York, not just because I'm from there these days, but also it is 40% of the CBD office market in the U.S. So if you talk about office markets, that's an important one to talk about. But it's not like every building carries vacancy at the same rate.
Right.
For the market overall, the institutional quality properties are actually kind of outperforming because they tended to focus on the more high quality, well-located buildings. It's the older stuff that need a lot more TLC that have problems. Now, that's kind of a CBD focusing. If we look at suburbs, actually cap rates for suburban office buildings are now lower than those for CBD office buildings. We've never seen that kind of pattern before. It came really close. They reached equality in the middle of the financial crisis. But what's going on with that, if you think about, cap rates are higher in CBD versus suburban, I think what's really happening is these suburban areas, people are able to underwrite a little higher income growth for some assets in the past. There's still that bifurcation issue of high quality buildings, low quality buildings, but high quality buildings in the suburbs now, it's going to be stuff that's highly amenitized, good locations. If people are not going to the office every day, the times they do go in, it works better if you've got like a nice mix of amenities. Sometimes people who work in the office building there use, sometimes folks who are in a hotel or live nearby use. So it becomes more of a mixed use environment. In suburban areas, you could probably build that up a little bit better. The other thing suburbs have going for them, and this is as a guy who lives in New York and takes the subway every day when I'm there, but the suburbs, because it's auto-focused, you didn't have as much of that negative stigma against going to the office that you had during the pandemic.
Right,
because,
you're in a car by yourself.
Yeah, you're in a car by yourself. So, and then you're going to a place where you trust other folks and you can mask as you needed to.
Right.
So you didn't have as much of a stay away from the office kind of thing happening. But that made them a little bit more flexible. You got that mixed use aspect. More people live in the suburbs, and so you have a shorter commute. I mean, the thing is, commuting, that's a cost, and the worker bears it.
Yeah, I think that's the worst part of going to the office. I love being in the office. Other than that, now you mentioned that transaction volume in the fourth quarter went up overall 32% from the quarter of the previous year, and 9% overall for year to year. Right. So how about office itself? It seems like we're seeing more activity. We're seeing it kind of jump up finally.
Yeah, office sales increased for the year. That's first time in a while we could say that. And part of it is actually driven by Manhattan. We keep going back to Manhattan, even though I'm here in Atlanta. But Manhattan saw property sales. So it wasn't like just one building drove it. It wasn't like some big portfolio sale nationally drove it either. It was a bunch of singles and doubles. And I think some of it is just that prices fell so much.
Yeah.
More than 50% in Manhattan. At that point, an investor who has been in the market forever, kind of family money, local developer, owner kind of person, they can look at that and say, it's a bit of a challenged asset today, but we've underwritten at this point. I think we could probably do that. So you've seen a lot of private money do it. There's been a few sales involving cross-border money, which is a lot like institutional money because they have many of the same demands on them in terms of hitting performance benchmarks, and they have the same institutional risks of maybe moving too early. But there have been some sales involving cross-border investors because a well-located office building in a place like Manhattan, if it's one of the surviving buildings, if it's one of the ones that's the higher quality and people understand the tenancies, that can look good to them. And also fits an operational efficiency thing. One fund manager I'm friendly with told me once he won't even hop on a plane unless he can spend $50 million at a time. I mean, you could spend $50 million easily in Toledo. You'd probably overpay for an asset there compared to what the cap rate would be. So those big buildings, even though there's worries about what happens next in offices, those big buildings can be attractive to some of those folks. But it's not as if they're just going to buy it because they have deep pockets and they could be like the private investors. They still have that institutional benchmark they have to worry about.
Yeah. Well, I think we're going to look back, in my humble opinion, at this decade when we're in the next decade. And I think we're going to look back and look at office was the buy of the decade. And these prices, I focus on selling office buildings mainly in the Southeast U.S. And some of these prices are just so incredibly low. It's like you can really lower your rates and really turn these buildings around, and in a growth market that is expecting to have, population growth, job growth. There's buildings being torn down. There's buildings being converted. There's no new supply. I think it all adds up to office being an incredible opportunity. And one of those property types in office as a special sector are government office, and those seem to be selling well on our end. But I know in one of your reports you talked about medical office, and we do medical office, and there seems to be great demand there. What do you see in the MOB world?
Yeah, medical office is one of the components of the office market that's doing well because there's a very predictable element to demand. We're all getting older. That's if
dang it,
anything I say as an economist, that's the most predictable thing I can say. Guaranteed 100% accuracy. Next year I'll be older than today. But it's the kind of thing that as you get older, you're spending more and more of your income on healthcare issues. And with the wave of baby boomers, where they're at, and folks after them, there's a bunch of folks trying to put money to work to kind of capture that demographic wave. The challenge is what happens once the baby boomers kind of age out of all that. Where do those assets get positioned then? So you have to think about not just buying it today and holding it for that generation, but then once you get to the Gen Xers, which is a smaller generation, do you have the same demand in place?
Yeah.
So you got to be careful on that and think about it. I mean, maybe you're not holding it that long.
Yeah.
But you have to think about it relative to future demographic needs beyond just the current one.
We're talking about things that you can say with certainty. One of the sayings I tell people sometimes that you remind me of by saying that is there's only one constant in this world, and that's change.
Absolutely.
Things will change. If you own that building long enough, it could get better. Or I guess can go the other way. Let's talk about hotels. What are you seeing there?
Yeah, the hotel market it's kind of marching to a different drummer on pricing trends, but it's also really bifurcated between the full service and limited service. And even the full service gets bifurcated based on what market you're in. So there's a lot to disaggregate there. The COVID crisis was kind of a case of kicking a man when he's down for the hotel market. Hotels had a hotel-specific financing shock in 2019. Big hotel development went belly up in Times Square in New York. And so the debt capital markets for hotels froze for a bit because everybody was worried, if this is a bad sign. Everyone likes going to Manhattan. A project went belly up in Manhattan. What's going to go on? So there's that uncertainty, and then hotel lending dried up for a period of time. You saw already a little bit of distress, and then combine that financial distress with the COVID crisis that brought the fundamental distress of people not traveling anymore. And you saw a big increase in the distress assets that were out there, just assets that were delinquent, couldn't pay their loans, had to be sold in a short sale or foreclosed on. So the hotel market had some challenges there. Then the revenge spending hit, right? People are traveling tremendously through 2022, but that just kind of brought prices back up to the previous level. It didn't it didn't lead to a surge in activity like in other sectors. It just kind of papered over some of the problems. It brought the growth rates back to zero, I should say. But since then, now we've seen prices decline, and continue to decline with this change in the interest rate environment and hasn't caught up yet like the other property sectors have. And I think some of that is just a bifurcated market with there's some full service assets in growing markets that are doing okay. But the conventioneering business in some of the expensive cities is just not what it was. And so that creates a bit of casts a bit of a pall over some of the expensive coastal markets and the high-end hotels in those places. One thing that's helping overall for the hotel market, though, like you go back to that 2019 shock, there was a ton of negative publicity around the Airbnb and VRBO and the other kind of short-term rentals of apartments kind of concept. That did undermine some element to hotel demand, but many municipalities are trying to restrict that kind of activity these days because we are chronically undersupplied in housing in the United States. We make it difficult to build rental housing at this point. And so you have a situation where we have a political desire to make things more affordable. And maybe if I just ban these temporary housing arrangements, that would help provide more units to the ownership and rental markets. So that also at the same time benefits hotels because some cities you just can't get Airbnbs legally like you could in the past. So that does help hotels to some degree.
Yeah, well, that's interesting. My daughter loves Airbnbs, and for some reason, I kind of don't like the hit or miss of it and the additional work to it for a hotel.
I know it's a generational thing. Like at some point you want predictability in life.
Yeah.
If I'm traveling someplace, I don't have as much free time, so I can't just take a risk on that. So a very nice hotel is probably more for the free time you have. There's that. But if you were 20 years old and living living for each day, you take a risk, you see what you get. And sometimes when you do that, there's fantastic things that happen. Sometimes not fantastic things too.
That's right. Well, to move on through some of these sectors, what about multifamily? What do you see for transaction volume, cap rates? Things?
Yeah, deal volume was up sharply for the year. But the funny thing, there was this AR Communities deal. It was like a $10 billion transaction last year. But the deal, that was like biggest deal in the market for the year. But that wasn't the whole market. Even if you strip that out, you still had growth in deal activity for apartments. Now, cap rates, they're starting to, they've been going up. It's not going up like well above the levels seen before the pandemic, but they're increasing from the lows we saw in 2022 when the syndicators are getting really aggressive and just buying up B-grade apartments in some cases and paying that premium for them. So some of the pricing changes to come back from those excesses are still being worked in, but there's still deal volume underway because there is a bit of a recognition on the part of investors that we are undersupplied in housing. There is tenant demand. It's a more stable asset class. And when people are living someplace and paying their rent, they just want to stay. They don't want to pick up and move every period of time. I think one of the challenges we have is that for apartments, you need this sweet spot of activity. You don't want to be in a situation where you so restrict supply that rents surge just because economics 101, limit the supply, increase the demand, you're going to get the prices increasing. That's what we saw in places like New York. It's frightfully difficult to build. The NMHC has done some calculations, and they think that about 40% of development costs for apartments now come from the regulatory burden. And so, and that's a national average. Some cities are much higher. So if you're making it very difficult to build it, then all those laws really protect current owners from new developers coming in and lowering rents. Now, on the other side of the equation, if you build too much, think of Houston in the 80s. This one fellow I worked with told me a story about how a niece of his would go move into a building, get 6 months free rent, and then it was before people would document contracts really well. And she'd leave after 6 months. And like for 2 years, she did that, just hopping from place to place. Yeah, not exactly ethical, but it highlighted the challenges of too much supply. So what you need in a place like New York, you have one bad government law restricting development, so it leads to more bad government policy to limit prices that investors don't like, because then suddenly they're not in control of how they're managing the asset.
Yeah.
So you need this Goldilocks zone of, you need some supply so that you don't have too much political pressure to kind of appropriate the ownership interests of the current investors, but not so much supply that you overbuild the market. So you need something balanced in the middle. And I think we're undersupplied at the moment. It's a challenge. Even like the state of Florida, at the state level in the Constitution, they made it so you can't have rent control. But so much demographic change has happened. There's so many folks who moved in and they even there, free markets and capitalism and everything, but there's still regulation. There's still problems on building. Yeah. And so you've seen some cities there trying to implement rent control, even though it's some form of it, even though you have some limits at the state level. Mm-hmm. So there is that political pressure because they're not in that Goldilocks zone. There's not enough supply. So again, they need more supply, reduce some of that regulation on development. I'm not saying make it so that anybody can build something that's like, get rid of the fire laws or anything like that. There's some safety things. You just, building standards you got to identify. Yeah. But so many things like setback requirements, parking requirements, just extra mandates there.
Time.
Yeah.
Fees.
Yeah. Those kind of things. They didn't have that in the 1800s when they built, so many big apartment blocks. So, if we can get that regulation more free flowing, maybe we get that Goldilocks zone of just enough supply to keep it stable without getting oversupplied and without getting too tight. Yeah.
If municipalities, if you want to have more housing, affordable housing, reduce the time. I just saw 2 offers in our shop in the last couple of days for new development of apartments. And one was a 2-year closing and one was a 1-year closing. How long it takes to run through the whole process. And that cost money. Right? Oh, yeah. So that's something to think about. Well, let's talk about one of the sectors that's been doing well for transaction volume cap rates. That's industrial. What do you see there?
Yeah, the industrial sector was the first sector to show price growth after the interest rate shocks. It continues to see price growth, but the pace of increase is slowing. It's not like it's going to continue to go up forever. There was a great deal of optimism around the sector in 2020 and into 2021 when everybody saw online shopping surge. Prologis did a study and figured out that for every $1 spent online versus $1 spent in store, you needed 2 to 3 times as much industrial space just to handle the storage of goods that's not in the store, to handle the shipping, to handle the returns. So that created an awful lot of demand for industrial properties. We saw an awful lot of supply too. We hit record levels of new supply for industrial. Yeah. And so you talk about record levels of new supply, people get nervous. Right. People worry that, is this like Houston in the 1980s again? Are we going to overbuild? And I'm not as worried about that in the sense that Houston in the 80s, you were building these big assets that take many years to deliver. An industrial asset, you got a concrete slab, tilt up concrete walls, 6 months, boom, you're done. So you can shut down that supply pipeline faster and easier once there's signs that there's no more leasing. Mm-hmm. So I'm not as worried that it suddenly oversupplies. But the construction has been in place, and so the price growth is starting to moderate compared to where it was. But there still is demand for space. Maybe it's not growing as fast as it did in the past. But if people set their expectations on just these, for future performance, on just these extreme parts of the market, like if you set your expectations that everything's going to be like 2020 for industrial demand forever, even a good market won't suit you well because you've set it too far. So we're still incorporating information. The market, I should say, is still incorporating information about how much supply has come in. How should we price things based on that? And so we're seeing some growth still, but it's not where it was. It's not coming in at the tremendous double-digit rates as before, but that's okay. Yeah, you don't have to have the market at the top of the market every day. Yeah. Overall, there's more activity. The sector is vastly more liquid today than it was from before the pandemic. Before the pandemic, a lot of folks viewed it as kind of a boring sector. Not tremendous yield, just some yield, never really moved, didn't get tremendous capital gains. Mm-hmm. That's safe, stable yield, though. That's very exciting today. People want that.
Yeah, I agree. Well, let's talk about another property type. Now, let's not do that. I want to ask you something else you brought up. I think my audience is thinking about, and that's the lenders, the debt market. What's your thoughts there on the debt market as we sit here in February of 25?
Yeah, the debt market has it's starting to turn the corner. We saw limited availability of debt for a bit as everyone was trying to figure out the change in interest rate environment and how do you make money out of that. And the folks who really came back first were the non-bank lenders. Mm-hmm. The increase in interest rates, part of it is these were folks who didn't have as much of an embedded portfolio to worry about. If I'm a big bank, I made a bunch of loans. They're tied up in commercial real estate where the asset values may be falling. For just about everything, it was falling. And so it was hard to continue to extend new capital in that kind of environment. Yeah. They would for their best clients. And some of them were 5-year loans, kind of the 3-1-1 term a lot of the banker folks use, 3-year loan, 2 1-year extensions. So some of that got extended. Mm-hmm. But there were new entrants, all these credit funds, a lot of leverage lending, and maybe doing some mezz stuff too. Those really took off, and we saw a tremendous growth in the number of new firms. Some of them were groups we had never heard of before, and you started doing some digging through the paperwork, and it's a couple of brokers who just decide to strike out on their own and become, instead of being mortgage brokers, become provide capital themselves. So that's been a change. But as prices start to stabilize and banks kind of work through the problem assets they do have on their books, I wouldn't be surprised to see them start jumping into the market again and displace some of those groups. I mean, one senior lender I visited with in New York the other week, was telling me that for a leveraged loan to a debt fund, I may earn 100 to 150 basis points over SOFR. But if I do all those loans myself, I may earn 300 to 350 over SOFR. So their preference is all day, every day to earn the 300. It's just they couldn't for a bit because their portfolio had too many questions around it. Mm-hmm. But once they work through those, I think the banks can start stepping back in where they have been displaced by the debt funds. Yeah. Unless and until the debt funds become more aggressive again and start competing in other ways, like increasing the LTVs they'll offer and fewer restrictions. Yeah. Because right now, even the debt funds, they're competing, but the LTVs are still low compared to where they were like in 2018 to 2019.
Yeah. Well, I would tell the lenders out there that I think this is a great time to do loans. You probably have less competition. You probably are getting a better return and building some great relationships. And if we are at the bottom of the cycle in a lot of markets, then they may be the safest, best loans you've ever done potentially. And let's end the show with, Jim, your thoughts on the cycle and where we are and prices of assets.
Well, actually, on that point, let me echo your point on the loan side. If you look at defaults on loans and look at the performance following the GFC, it was the stuff that was originated right afterwards where asset values had reset. Yeah. And then you're coming in with the low LTVs still tied to the recession period. Yeah. So you get a low LTV at a record low base, and then those prices start growing. All of a sudden, the embedded LTV starts shrinking because the value is just going to pick up from there, as long as that value continues to pick up. And so if we look at the different sectors today, there was a worry from a lot of investors, not just worry. Some folks had it as an investment plan, thinking that, well, prices will decline exactly the same way this time as the financial crisis, because in part, it's the only experience they had. They only came into the industry after 2009, so they only have one cycle under their belt. Yeah. Whereas I knew that every cycle is different. But this thought that if prices had fallen as much in this environment as in the financial crisis, then there'd be a lot more distress, a lot more challenges. But It didn't fall nearly as much.
Yeah.
It's already starting to recover. It's like it is just a one-time shock that hit the market from a higher interest rate environment to start hitting 2021, 2022. And it just took 2 years for the market to really absorb that information and start to reprice it. Real estate takes a bit of time to reprice. It's not like trading bonds or trading a bushel of soybeans in Chicago. It's not like that.
Yeah.
It takes 2 years of going to every conference, talking to every broker. Hey, what do you think about this? And the broker's talking about already figuring out what their desire lines are. What kind of assets you looking to buy? It takes a long time to make a market in the commercial real estate world compared to other asset classes. So it took about 2 years for that information to be incorporated. I think it's being incorporated now. We've seen the price declines slow. They've really moderated. Many are on a path where if they continue the last couple quarters of trend, you'll start seeing price growth again. And that was the case with like retail. And so we'll see if it happens with the other sectors. If the market just had that one-time shock in 2021 and 2022, and there's no other external shocks that really throw so much uncertainty that mortgage rates go up again, then maybe we've incorporated that and you could get to some decent price growth again for every asset class.
So if you looked at the overall commercial real estate multifamily sector and you said, point to where we are in the cycle, the bottom, close to the bottom, maybe slightly on the way up. But
And the real challenge, I think, in putting your finger on that, is that the story is going to be different for every city.
Yeah.
It's always different for every city. I mean, there's every cycle, every time period, that's the case. But there are some that are already moving through the repricing events to looking to get some more growth in the market now, such that maybe you get some construction activity, even with the higher costs, even with limits on the ability to deliver, because you've seen some decent price growth. Whereas others are still kind of hampered a bit with the uncertainty of how the market's recovering following the downturn. So there's a bit of a bifurcated market. I'd look more towards cities that have stronger demographic growth, because that can feed through to more tenant demand and potentially higher income growth. It depends on that balance of supply, though. If you're in a market that's oversupplied, there's not many. It's hard to build everywhere, but keep an eye on that demand side as well.
Yeah. Final thought on opportunities.
Opportunities. Here's one. We didn't talk about opportunity zones.
Oh yeah.
There's we have a new administration in, and there's a lot of talk about what's going to change, what's not going to change. Arguably one of the most successful things from Trump 1.0 was the opportunity zone legislation, helping to incentivize construction and development in parts of cities were kind of underutilized. A surge of investment capital flowed. There's talk of maybe repeating that this time through. I'd keep my eye out for that to see what kind of legislation comes through. Maybe there's another round of opportunity like that.
Yeah, good point. And the opportunity zones are that's a very nice program. And if you want to know more about it, we've done a show on it. We'll put a link to that. Well, Jim, thanks for being here in Studio One, and thanks for the information. It's great as usual.
Oh, always great. Thank you.
All right. And thank you for joining us around the country. And if you like more from Jim Costello and MSCI Research, check them out. Their website is msci.com. And our website is creshow.com. Please connect with us. And thanks for sharing the show and providing your comments. Until next week, make sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.